Hey all, in this video we're going to be looking at types of profit and also profit maximization. And so with profit maximization, it's really the golden rule of macroeconomics, so make sure you guys know and understand everything that we're talking about in this video. Let's go.
All right, so profit maximization. And so the first thing we're really going to look at is going to be types of profit. And so remember, when we talked about elasticity, we talked about something called the total revenue test. And the total revenue test, it just basically told us the elasticity of our demand curve. And we said that total revenue just price times quantity, right? The price you're selling the good times the quantity that is produced. Well, here, right, we're going to add on slightly more and differentiate that and add in profit. Well, our profit is going to be our total revenue minus our total cost. Right? So remember, there is a difference in revenue and profit, right? Profit is just how much money you take home, right? If you're factoring in the cost of producing those goods, while revenue is just how much money you make without factoring in those costs there. And so the reason why we're talking about profit is that there are really two different types of profit that you need to be aware of. The first is going to be called accounting profit, and the second is going to be economic profit. And then I'll leave you guys to guess which one that we're going to use. So here, for accounting profit, they are only looking at something called explicit costs. And explicit costs are just the payments made by firms or paid by firms for the use of different resources, right? So in other words, explicit costs are just the normal costs of business that we take into account. So if you are running a taco stand, right? If you're running a taco stand, the explicit costs are going to be the tortillas. They are going to be the rent on the building, the utility bills. They're going to be the different types of meat that you use, the cheese, the sour cream, whatever, right? So here, explicit costs, like I said, are just the normal costs that you associate with doing business, right? The cost of all these different resources. And so to figure out our accounting profit, it's just TR, which just stands for total revenue. Right, so total revenue minus the accounting costs, which are basically just explicit costs, right? So it's just accounting profit equals total revenue minus our accounting costs. Well, for us, we don't necessarily care about our accounting profit, right? Because it doesn't take into account our implicit costs. So when economists look at profit, we take into account both the explicit costs and the implicit costs. And so what implicit costs are is just the opportunity cost of doing business, right? And that's what you see on the definition here. And so, for example, right, if let's say I decide to run a taco stand, right, we all know what the explicit costs are, right? The explicit costs are just the cost of all these different resources. The implicit cost is what I'm giving up to run the taco stand, right? So for me, the implicit cost would be giving up my job as a teacher, right? And so I'm giving up my salary, and that is included in the implicit cost of running the taco stand, right? And so here, right, economic profit is just total revenue minus our economic costs, right? Our economic cost is just our explicit plus our implicit costs added together. Right? So if we add up our explicit costs plus our opportunity cost of doing business, that gives us our economic cost. And then if we subtract that from our total revenue, that gets us to our economic profit, which is what we care more about in this class compared to accounting profit here. All right, and so here's this guided practice. It's just a quick sort of review, just a quick thing to make sure you guys understand accounting and economic profit. The answers are in sort of the notes section of the Google slide, right? So you guys can check the work yourself. And so when we're talking about economic profit, right, when there is no economic profit, we are going to call that a normal profit. And so remember, just because you have $0 worth of economic profit, right, yes, we're going to call that a normal profit, but that does not mean you're not making any money, right? According to accounting profit, we are making money by having no economic profit here. The reason why is economic profit, remember, also includes our implicit costs here. And then in real life, right, we're never going to take into account our implicit costs, right? If I'm running a ledger, right, if I'm being an accountant, I'm never going to take into account or write in the books the implicit costs of what the company would rather do. Instead, you're just solely looking at the explicit costs here. However, for economists, right, we do take into account implicit costs, and that's why when we say when there are no economic profits, we're just going to call it a normal profit here. And so from this point on, whenever you see the word profit, we are always going to be discussing or including the economic cost. We're always going to be including the implicit cost of doing business. And so the last thing that I wanted to go over with you guys in this video is going to be profit maximization. And this is extremely important. So if we look at this, right, assume every unit can be sold for $10. Which unit maximizes profit? Well, here you can do the big thing, just say 1 times 8, 2 times 6, 3 times 8, 4 times 10, 5 times 12, right? Yes, we can do that. However, the easy thing is we're just going to produce here at 4, right? And so the reason for this, right? The reason for this is what we're going to get into. But before we get into just really the major important thing is we first have to talk about the goals of business. So first off, what is the goal of business? Well, the goal of business is to maximize profit, right? And the goal of any business should be to make money at the end of the day. Well, to make money, to maximize profit, what firms have to do is they have to find the right amount of output, right? They have to find that sweet point of how much to actually produce. If they produce too much, well, they're not going to sell the excess surplus, and so they're actually technically losing money. If they sell too little, right, well, they could be making more money if they increase production. So to maximize profit, firms have to find the right amount of output. And so we are going to say firms should continue to produce until the additional revenue from each output equals the additional cost, right? So I'll repeat it. Firms should continue to produce until the additional revenue from selling that product equals the additional cost from producing that product here. And so an example. So let's assume that the price of a widget of a product is $10. Well, should you produce if it costs you $5 to produce another good? Well, the answer is yes, right? You're making $5 extra there. Well, should you produce if the cost of producing an additional good is $9? Well, yes, right? Because you're selling it and you're making $10, but it's only costing you $9 to produce. Well, the last one is should you produce, right? So we'll just write yes. Well, should you produce if the cost of producing another good is 11? Well, no, at that point, you are not going to produce that extra good because you're bringing in $10 because the price is $10, but it's costing you $11 to produce it, right? So we're not going to produce at that if the cost of producing the good is $11 there. And so that brings us to really the golden rule of micro, right? This is one of the most important rules of microeconomics, is that firms are going to stop producing, or firms should produce at where marginal revenue equals marginal cost. Or you're going to hear this term a lot, where MR equals MC. And the reason why you need to know this, and the reason why it's so large in letters and it's highlighted, is that this is the profit maximizing rule. If you can find the point where the marginal revenue curve intersects with the marginal cost curve, that is going to be the profit maximizing spot. That is the point where all firms should produce at to maximize their profit. And earlier we said that the goal of all firms is to maximize profit, so that means they should always be producing at MR equals MC, where marginal revenue equals marginal cost here. And like I said, this is the golden rule of microeconomics. If there's one thing you memorize and take away from micro, it is this singular rule here. All right, guys, so that is all I have for you guys today. I hope you guys learned a lot, and I'll catch you guys in the next video. Peace.